Okay, so the first question, which we are going to do, that is the Cosmore company, and it is a 50 marks question. Okay, in this question, examiner is testing the investment appraisal, the sensitivity analysis, as well as the discussion was very important for this question. Okay, so uh, very good question it was, I will say. A part of the question, the first part, examiner is asking evaluate the financial acceptability of the investment in ice cream manufacturing. So simple, you have to apply the NPV analysis. Then examiner was asking the percentage change in revenue required for the investment to have a zero net present value. So we have to compute the sensitivity of the selling price. Then the percentage change in investment expenditure required. So on the second part, we have to compute the sensitivity of uh, initial investment and evaluates whether the calculation in one is more sensitive to revenue or investment expenditure. So when we have computed both of them, so we have to tell which is the most sensitive and which is the least sensitive. And then include in your calculations the effects of tax as well. Okay. And then the third part of the question, examiner is asking the process for and problems with incorporating project risk into the cost of capital, the investment in ice cream manufacturing, and the problem with linking risk assessment to the cost figures in the investment appraisal. So this discussion part was very important. The process for and the problems with incorporating project risk. Can you tell me what the examiner is meaning by the incorporation of the project risk into the cost of capital? Can you please clarify what the examiner is really talking about this?
Like the risk of the project that they're currently undertaking,
So,
how much is it going to cost them?
it is known
The
as the
risk of
risk adjusted wacc. Do you
okay.
remember? There's a topic,
Yeah.
the risk adjusted wacc, when you are adjusting your risk according to the investments taken. So the last part of the question in which the examiner was saying, discuss the limitations of the linear programming as a basis for choosing between investment projects in multi-period capital rationing situation. So in this question, examiner has also tested the capital rationing. And the fourth part, we forgot that discuss the limitations of sensitivity analysis as a basis for deciding whether to invest in a project with reference to the calculation performed in part 2. So this is a very good question. This question is covering investment appraisal, sensitivity analysis, somehow risk-adjusted wacc, and somehow the linear programming, the multi-period capital rationing. Okay, so let's start. C Company is a manufacturer of fruit-flavored drinks. C Company is continually investing in product development. So this company is doing the drinks business. C Company is currently considering a major strategic development to invest for first time in food manufacturing. So this is the first time. The proposal is for C Company to start manufacturing of ice creams. The investment in facilities to manufacture the ice creams would mean that funds to invest in other products would be limited for the next few years. So as you are going to invest in this project, so in other projects, you cannot do the investments. The finance department has prepared estimated for the investment in facilities to manufacture ice creams. The finance sector is particularly concerned about two elements: the cost of the initial investment in the facilities to manufacture ice cream. So this is the first, that from where the initial investment, from where the funds are coming, and the selling price. The sale directors have suggested the price should be increased regularly but that a lower initial price may have to be set to establish C company's ice cream in the market. So this is no, what was that? We have studied in our previous course, there was a pricing strategy which was known as penetration. Means just to penetrate in the market, first charge the lower price, and when the customers are used to it, then we may increase the price in future. Because this is the first time you are going to do this ice cream manufacturing. So you have to capture the market. So some directors have queried about the assessment of the risk of the investment is reflected in the cost of capital and the operational cost figures in the investment appraisals in C companies. Finance director want to respond to their concern. So this is the part which the examiner has asked. Some directors have queried how the assessment of the risk of investment is reflected in the cost of capital. Mean, as this is a new business, so the company is going to do this new ice cream manufacturing. So how the ice cream business risk will be incorporated in the cost of capital and the operational cost figures in the investment appraisal. And C company finance director wants to respond to their concern. The finance director also wishes to look at how C company choose between investments when there are constraints on the fund which can be spent. So when there are constraints, this is known as a capital rationing situation. So, Miss, please capture the screenshot of this part as at your side it is not being opened. So you can tell me the figures as well. Please capture a screenshot.
Yeah, I've got it.
Okay, now the second part. So this is the project which we are going to start. What the examiner is saying to you the project should be assessed using a 4-year time horizon. Revenue and quantities of ice creams sold in 4 years can be assumed to as follows. Examiner has told you that the revenue and the ice creams which you are selling every year, the price of each ice cream sold will be 2.50 in year 1. Okay, rising by 5% each year in year 2 to 4. Okay, the cost can be assumed to be 3.8 per ice cream in year 1, and cost is in real terms can be assumed to fall at an annual rate of 4% in years 2 to 4 due to economies of scale. However, there will be also subject to annual inflation rate, which is follows. In year 2, 6%, then 8%, then 4%. So examiner is saying to you people that the cost can be assumed to be this one in the year 1, and this is cost in real terms can be assumed to fall at an annual rate of 4% in year 2 to 4, but they will also subject to annual inflation rate, which is as follows. So this is a good understanding. Now, the ice creams will require forecast investments in manufacturing facilities of 16 million. Tax allowable deduction is available on the facilities at 25% per year on a straight line basis. With a balancing allowance or charge available at the end, the facilities can be assumed to be sold at the end of 4 years for 10% of the original investments. So we will see that in the final year, there will be a balancing allowance or charge. The working capital required at the start of the first year will be 12% of the first year revenue. For the second to fourth year, working capital can be assumed to increase by the annual rate of inflation. Working capital is fully recovered at the end of year 4. Then C company has $75 million one shares in issue with the current share price was 3.8. The market value of the C company that is 40 million and its pre-tax cost of that is 9.2. Now H company has been identified as an established ice cream manufacturer company with the same business risk to C company's new project. H company has 50 million 0.50 shares in issue currently trading at 2.2 Edge company equity beta has been given 1.44 and the market belief that is 30 million. So my question from you, Miss, that why examiner has provided you the edge company in this question?
So you can use the information because it's a similar company.
Because as Cosmore company is going to start a new project. So Cosmore company has to incorporate the ice cream business risk. So that's why examiner has provided you a company which is already doing the ice cream business. What we will do? We will ungear that company beta and then we will re-gear that beta with our own gearing levels. The current risk-free rate was given as 4.5. The market return assumed to be 11.5. That can be assumed to be risk-free. Taxes payable 25% for both companies in the year in which profits are made. Any tax losses can be assumed to be set off against other profits made by company in the year in which the losses are incurred. Now, Cosmore company has been considering 3 other long-term projects where investment expenditure will be phased over 3 years. Maximum expenditure on these 3 products in total 6,500,000 for year 0, 500,000 in year 1. All 3 projects can be scaled down but not up. It is assumed that none of the projects can be postponed to a year later. So, as given the multi-period capital rationing constraints which it faces, Cosmore is postponing to use linear programming to determine which product should be undertaken. The linear programming model has been formulated as follows. First of all, remember, whenever you are having the single period capital rationing, in the single period capital rationing, when the projects are divisible, so you know what we do? We compute the probability index and based on that, we put our funds in the projects. And when the projects are non-divisible, then what happens? In the case of single period capital rationing, when the projects are non-divisible, we select the combination of the projects, which gives you the maximum NPV. But when the we are having the multi-period capital rationing, first of all, try to understand what do you mean by the multi-period capital rationing? When the funds are limited more than 1 year. So what is happening? In the current year, you are having this constraint. And then for year 1, which means that this is not a single period. This is the multi-period. And examiner has told you multi-period capital rationing constraints. So remember, multi-period capital rationing calculation is not a part of our course. Only the discussion can come. The single period capital rationing calculation is a part of our course. Okay. So what is happening? Maximize. We have to, what is happening in year 0? For the project 3,000, the examiner will tell you examiner has told you that for the project P, which is the first project in year 0, the requirement is 3,000. For project 2, 2,800 and project 3, 2,500 is required. But remember, this should not be greater than 6,500 because in year 0, you have the maximum amount 6,500. So it should be less than or equal to 6,500. And in the same way for year 1, for the first project, 2,500 required. For the second, 21. For the third, 1,800. And again, this should be less than or equal to how much? 5,000. So this the examiner was asking what the linear programming actually tells. So miss, the question is opened at your side or still not?
No. It's not
Okay.
working. I don't know why. It's not letting me log in.
Okay, so capture the screenshot, please.
Yeah.
Okay. Capture the other part as well.
Yeah.
You can capture this one as well.
Yeah. Got it.
Okay, now you will perform the calculations along with me as well. Okay.
Okay.
Okay, now, first of all, examiner was saying that we have to tell the examiner the financial acceptability. What we had to do? A part of the question in which examiner was saying to you the A first part, financial acceptability. So what was the project lifespan? What was that?
4 years.
4 years. So we will take year 0, 1, 2, 3, 4. Okay. Now must tell me, in this question, you had been provided the revenue. What was that revenue?
14,300.
Then
18,018. 23792. 32205.
this was given. Now for the cost. What was the cost? Can you tell me?
£5.20 per so.
The
1
cost
second.
we had to compute.
Yep. 1 second. I'll just work it out. 14. Oh, you already.
Now see,
Mm.
we have year 1, 2, 3, and 4. Now you tell me, what was the quantity given?
For the first year, 2,750.
First year 2,750. And what was the cost given? Year 1 cost. The per
$3.8.
$3.80. Okay. So when you will multiply, what is the answer coming?
10,450.
For year 2, what were the number of units?
3,300.
Now, the price was?
It falling at an annual rate of 4% in years 2 to 4.
So if it is first falling, how much we will take?
0.96.
How we are
It's falling by.
it was 4%.
Yep.
So what the value will come? Mean you will take the 96% of this.
Yep. 1 second.
0.96 and then
Yep.
inflate it by the inflation level given. What was the inflation for the second year?
6%.
6%. 1.06. This is the given that 4% decrease. This is the inflation. So you will get 12761. Understand?
Yeah.
Now the third units were given 4150, again 3.80, but the 4% was per year. As we have from, this is the base year. So from base year, this was the year 1, this is now 2 years. So you will take how much?
1 minus 1 minus 4% to the power of -2.
So in simple words, you can say 0.96
1.08.
raised to power 2.
1.08.
What is this answer coming? 0.96 raised to power 2.
0.92.
Now inflate. Now to get the year 3 figure, as the 3.80 is the year 1 figure. First inflate with the year 2 inflation, then incorporate the year 3 inflation, because the inflation levels are different. So previous was 1.06 and now the year 3 inflation is 1.08.
1.08.
So you will get 16638. Okay. Then
Yeah.
the last units were 5350. Again you are having 3.80 and again reduce it, but as this was the per year, so now as this is the third year, so 0.96 raised to power 3 and then 1.06, 1.08, and what was the inflation of the last year? 8%.
1.08.
So
Yeah.
1.08. So you will get 22238. So this is your cost. This cost we will place here 10450, 12761, 16638, and 22238. Okay. Now
Yeah.
here we will deduct the tax allowable depreciation. Now how we are going to compute the tax allowable depreciation? See now. Examiner told you. Number of years are
4.
4, and you will take the return down value and you will take the capital allowances or TAD. What was the value? What was the expenditure? 16,000. This was given.
Yeah.
Now
16 million.
we are taking the 1,000 common. So 25%.
Okay.
What is the value coming? 4,000.
Yep.
So what is the balance?
1,200. 12,000.
Again take
3,000.
but
3,000.
Hold on. What was the tax level? It was 25% on reducing balance basis, or it was straight line method?
Straight line.
If it is straight line, then why we are doing so? What was the formula for the straight line? Tell me. Initial investment minus scrap value.
Yep.
Initial investment minus scrap value over useful life. What was the initial investment? 16.
Yep.
What was the scrap given? Examiner said it will be 10. How much? The last point. See,
10%.
10% of the original investment. So how much that will be? 1600.
Yep.
Useful life 4. So how much capital allowances?
15,600.
16,000 minus 1600 divided by 4.
3,000. 3,600.
3,600.
Yep.
Just let me see. Hold on. Okay. Now see what is going to happen. Examiner is very sharp. Examiner in this question tried to confuse. See, first examiner is saying that you have to apply straight line basis with a balancing allowance or charge available at the end of 4 years. It's mean that we have to go through the calculation of balancing allowance and charge as well. Okay.
Okay.
So see, what we will do, the calculation will be in the same way. Here,
1.
return on value and tax allowable depreciation. Now see, year 1, 2, 3, and 4. This was 16,000.
Yep.
Now, as a straight line method, we had to apply. So if you divide 16,000 over 4, what is the answer coming?
4,000.
It's mean that every year you will compute the 4,000 as TAD. Like this is 4,000. What is the answer? 12,000.
12,000.
Then again we are having the 4,000. 8,000.
8,000. Yep.
Again we are having the 4,000. 4,000. Now, when we are having this 4,000, examiner said that we are going to sell the asset for how much?
The remaining 4,000.
1,600. This was the sale price. So for 4,000 minus 1,600, how much is the balance?
1,200.
1,200 or how much?
No, actually, no.
2,400.
Yeah.
So now see, asset was having a worth of 4,000. You are going to sell the asset as 1,600. You are selling the asset as a loss. So this is a balancing allowance. Okay.
Yeah.
Now see, it was a a very strange calculation that examiner was saying apply the straight line method, and then in the last year you have to compute the balancing allowance or balancing charge. That's why first we computed what should be the tax allowable deduction in every year. That is there. And then we are comparing this with that of the sale value. Okay.
Yep.
But this question means that the normal formula which we follow, that is we take the 16,000 investments, initial investment minus scrap value, that was 1,600 over 4. What was this coming?
3,600.
The question is, sir, why we are not applying this formula? So the answer is that as in the final year, we have to compute the balancing allowance or balancing charge. But when we are having the straight line method, in the straight line method, we never computed the balancing allowance or charge, because already we have deducted this scrap value from the assets. But if we have to compute that, so that's why we are not deducting this scrap value from here. We are comparing this scrap value by the end of the line. Understand?
Yeah.
So this TAD we will place here. In the year 1, 4,000, 4,000, 4,000, 2,400. So what are your pre-tax cash flows? $150.
Yep.
Loss 1,257, 3,154, and 7,567. Apply the tax. 25%. Examiner said the losses as the other projects are available, so we can claim the savings. That will be 38. Here pay the tax 314, 789, and 1,890. Now add back the tax allowable depreciation 4,000, 4,000, 4,000, and 2,400. Now initial investment. That was how much? 16,000.
16,000. Yeah.
Scrap value was
1,600.
1,600. Now the last adjustment for the working capital. Now, what the examiner said for the working capital, how much that will be? Tell me.
For the first year, 12%, and then for the second to the fourth year, it'll be based off the inflation rate.
So for the first year, what it will be? 12% of the sales?
Yeah.
So our sales are how much?
14.
14300
Yeah.
into 12%. How much that will be? 1716.
70. Yeah.
Now for the year one, what the examiner said? Because we are taking the working capital in advance. So year one, you have to take the year two figures. So what the examiner said? Please go through that line.
You will, for the
Inflate.
second to the fourth year, working capital can be assumed to increase by the annual rate of inflation.
So what is the problem? This is 1716. Increase it. What was the second year inflation? 6%.
6%.
So 1716 into 1.06. What is that?
1818 or 19.
Again, see. What was the year two inflation?
6%.
Now see.
1928.
This was again try to understand. See, miss. Examiner said for the second to fourth year, working capital can be used to increase by the annual rate of inflation. Working capital is expected to be fully recoverable at the end of the fourth year. Working capital can be assumed to increase by the annual rate of inflation for the second to fourth year. So as this is 6%, so it will be 1.06.
Yeah.
So how much
Or
this is
just
coming?
6.
How much?
1819.
1819. Then what was the third year inflation?
8%. 1964.
Now see. What is that figure coming?
1964.
You are inflating 1819 multiplied by what
Yeah.
was the inflation? 8%?
Yeah.
What is the answer coming?
1964.
And then 1964 multiplied by 8%.
2122.
2122. And this is the working capital required. We have to compute the working capital changes. Negative 1716. Then what is the difference?
1 second. What does that say? 17. So 0.
1819 minus 1716.
1 second. 1819 minus 103.
Then
145.
then
158.
then All this will be recovered. Add all the figures. How much?
1 second. 2122.
So this we will place here. Negative 1716, negative 103, negative 146, negative 157, and positive 2122. What are your net cash flows? Negative. Hold on.
17716.
Okay. The first figure, how much?
17716.
7716. Then we have positive 3785.
Yeah.
Then 4797. 6208. And this will be 11797. Now, in this question, the discount factor again we have to show in the working, because this is a ice cream business, a new business. Examiner has told you a proxy company. And the proxy company name was Wholewell Company. The Wholewell Company beta equity was given. How much was that beta? 1.44.
Yeah.
We will convert this beta equity into beta asset. Apply the formula. You know, beta asset is equal to beta equity is 1.44. What was the market value of this proxy company? The number of shares were 50 million. Per share value was 2.2. And its debt market value was also given. So this is
30.
1110. 1110 plus 30. And the tax was 25%.
5%.
So you will get the beta asset. That is come as 1.195. Now re-gear, but with on gearing levels. Re-gear with on gearing levels. Do not again re-gear with the proxy. You are not solving the question for the proxy company. You are solving the question for the Cosmore company. So the beta asset is 1.195. Beta equity we have to find. Now the value of equity for the Cosmore company was given. Its number of shares were 75, per share price 3.8. So this is giving you 285. So 285, and its value of debt was given as 40 into 1 minus 0.25. So you will get the beta equity 1.321. Understanding, miss?
Yeah.
Now put this figure into the CAPM. What was the risk-free rate? 4.5. And the beta equity is 1.321. Market return was given as 11.5%. RF is 4.5%. So when you will compute, the cost of equity is coming
Yeah.
as 13.75. Now you have computed the cost of equity. You can compute the wacc. This was 13.75. Value of equity is 285
85.
divided by total value. What is this total coming with? 285 plus 40. How much?
330.
3,
330.
330?
No, one second. 425. 420. No.
No, miss. How
Where's
this
it?
will be?
325.
Plus. What was the cost of that? The examiner told you in this question, the cost of that. What was that? 9.2%. But this was pre-tax. Make it after tax. Then multiply by 40 over 325. So you will get the wacc 12.9 or say almost 13%. This 13% we will use here, apply the spreadsheet functionality, and you will get the NPV of the project. Tell me, what is the NPV coming? Apply the spreadsheet function.
1 second. $821.32.
How much?
1 second.
No.
1 second. Yeah, well, I'm getting 821.32.
How you are comparing?
So NPV open bracket 13%,
Okay.
comma, the sum of all of them.
No. When you are taking the 13%, then comma, select all the cash flows from year 1 to 4. Then bracket close,
Yep.
and then add the year 0 cash flow.
Okay.
What is the answer?
1 second.
How much?
I'm going 9. I'm getting a really stupid number. This is not right.
How much you are getting?
18,644.
This is possible, yes. Okay, see here. Calculated or not? You computed or not?
No.
Okay, see here. Can you see the spreadsheet?
Yep.
Okay, tell me the number of years are how much?
4.
Not 4, 0 to 4. Okay, tell me the net cash flows.
Minus 17716.
Negative
17716.
17716. Then
3785.
3785. Then
4797.
4797. Then
6208.
6208. Then
11797.
11797.
79. Yep.
Now we have to compute the NPV is equal to NPV. Rate is how much? 13%?
Mm-hmm.
Comma. What is this coming? How much?
928.
So why you are
Yeah, that's
computing
what.
wrong?
Yeah, I was getting a percentage, so it was confusing me.
Okay. So this is coming as 928. So 928 will be the NPV of this product. As the NPV is positive, so we should accept the product. But the question was quite interesting. Now, what we have solved, we have just solved the first part of the question, the 13 marks. Now we have to compute the percentage change in revenue required for the investment to have zero NPV. Yes, do you remember the formula for the sensitivity analysis? Do you remember? The sensitivity analysis was having a general formula. What was that? You will take the NPV divided by present value of after tax variable. So as first we are computing the sensitivity of which? What was? Sales.
Yep.
Okay. So here the variable is the sales. We have to first make them after tax and then we have to compute the present value of them. So number of years, 1, 2, 3, 4. What are the sales? The sales were given to you as, tell me, you have computed 1300,
14.
143,
Yep.
then 1,
18018.
then
23792.
and the last
3220. 32205.
32205. First of all, what is the rate of taxation? 25%?
Yep.
So let's apply the 25% tax.
3575.
3575. 75. Then
4504.3 four
4.
five zero five
Then
5948 8051.
now what are the after tax values?
17875. Oh no, 1 second. 10725
10.
725
Then
13514
then
17844
and the last.
2415354.
Now as we have to take the present value. So our discount factor we have already computed as 13%. So miss, tell
Yeah.
me, apply the discount factor on the spreadsheet and tell me what is the present value coming. Hurry up. Again, type the NPV formula is equal to NPV 13%. Select all the cash flows and that's it. So what is that coming?
15. 1 second. 47254
472.
54.
This is the present value. 47254. Now apply the formula. NPV you have already computed. What was that? 920. What was that? 92
Sorry, 928.
928. So you will apply here 928000 divided by 47254 multiplied by 100. How much is the sensitivity coming?
1963.
1 point.
19.6.
Again compute. This is we have taken if 928. So then we should also take in the total form. Okay.
1963.
Again compute, miss.
0.19. 0.2.
92800 divided by 4725400 multiplied by 100.
1.96.
Now it is 1.96, almost 2%.
Yeah. Yep.
So what you will tell the examiner? As the sale is an inflow. So you will tell the examiner if the sales will decrease by 2%, the NPV of the project will become 0. Understand?
Yeah.
Now, if you have to go for the sensitivity of initial investment. Now, what is the formula for that? You will take initial investment as this is in year 0, so its present value will be same. Now, on the initial investment, what was happening? Yes.
It was 16 million.
What was that? 16 million?
16. Yeah.
Then we are having 4,000 capital allowances
Yep.
from year.
1 to 3.
So, okay. And then in the last year, we were having the scrap value.
Yep.
What was that scrap value?
1,600.
Okay. And then there was a balancing allowance as well in the last year. Do you remember?
2,400.
Yeah. So now what will happen whenever you have this? So we will take NPV divided by initial investment plus tax savings on capital allowances
Yep.
plus scrap value. So let's apply that. Initial investment,
8,000.
hold on. Initial investment we will take as it is. How much was that? Because this is in year 0. So that we will take as it is. What was that?
16,000.
So here you will take 16, not 16,000, 16 million.
Okay.
Now, as you know, what was happening in year 1, 2, 3, and 4. Here we were having the capital allowances. In the last year, there was a balancing allowance. Do you remember?
Yep.
So the capital allowance was how much?
4,000,
So
4,000,
instead of
4,000.
again, hold on, as the 4,000 is a constant cash flows for the constant time period. So why you don't apply this with the annuity factor for 3 years? So the annuity factor for the 3 years that will come as 2.361. And then the rate of tax was how much? What was the rate of taxation? 25%.
25%.
So 0.25. What is the value?
2,361.
2, 3.
61.
And for the balancing allowance, that were coming as 20.
400.
So again, as this is the 4th year, so the 4th year discount factor, that is how much? 0.613. And then again, make it after tax. How much is the value?
367.8.
Now the scrap value. The scrap value was given as
16.
1,600. And the last year discount factor is 0.613. There is no need to after tax the scrap value. How much?
Um, 820. 821.
82,
1.
821.
Yep.
So now this is the
No, sorry,
investment.
sorry. 1 second. 980, sorry.
980.
981.
Now, as this is the investment, 2 as negative, these are the positive. But remember, this is again take the 3 zeros here as well. Take the, or if you don't want, okay, negative 16,000 plus 2361 plus 367 plus 981. What is the balance?
Minus 12290. Point.
So
Yeah.
12290.
2. Yeah.
This is coming. Now
Yeah.
the NPV of the project was 928 divided by 12290 multiplied by 100. How much is the answer?
7.55.
So out of these two, which is the most sensitive? The revenue. Because in the revenue, if only a 2% change is there, then PV is becoming zero. But for the investment, if you will have to change the investment by 7.5%, then the NPV will become zero. So this is the least sensitive. This is the most sensitive. And as this is the investment outflow, so this will be increased by 7.5. This will be decreased by 2%. Understand?
Yeah.
Now, let's see the calculations we have done. The theory of this was very important. First of all, as this is a 50 marks question, so report, because in the 50 marks question, always you have to follow the report format. So you will tell the examiner report to the board of directors of Cosmore company, and then there should be an introductory paragraph. So you will tell in the introductory paragraph, this report provides a financial evaluation of the investment in ice cream manufacturing, Appendix 1, and looks at the sensitivity of revenue and the initial investment in Appendix 2. When you are telling the examiner that you have performed the calculation in Appendix 1 and Appendix 2, so that is very much important that examiner will be looking that where you have performed the calculation. And then its report discuss how risk is incorporated in the investment appraisal and discuss the issue with using linear programming to determine which investment to choose if multi-period capital rationing applied. So can you acknowledge that this introductory paragraph is nothing? It is just the requirement of the question which you are copy pasting. Okay.
Mm-hmm.
Now, the positive NPV shows that the investment in ice cream manufacturing should be undertaken. The sensitivity calculation shows the net present value is more sensitive to changes in revenue than changes in initial investment. Why? Because the revenue sensitivity was coming as 2% and the initial investment sensitivity was coming as 7.5. Now the report should be having subheadings like risk is incorporated by the use of the beta to determine the cost of equity, which is a part of the cost of capital. The beta factor used is the beta factor of H company, a proxy company in the food manufacturing sector, which appears to have the same business risk profile. This beta factor is influenced by the financial and the business risk of H1 company. So what we are going to do? So it is adjusted to take out the impact of gearing and find a beta which will reflecting H company business risk only. What the examiner is saying? The beta which was given to us for the proxy company, that was representing the proxy company business as well as the financial risk. We are assuming that the business risk of both our company and the proxy company is same. That's why we change this geared beta into ungeared beta, because the ungeared beta is only representing the business risk. We have already said the business risk for both of the sectors will be same. And then what we are doing? This beta factor is in turn adjusted to reflect Cosmore company gearing and financial risk. The adjusted beta is used in the capital asset along with the market and the risk-free rate to determine the cost of equity. And then some of the problems with the calculation of cost of equity this way relate to limitations of the capital asset pricing model. Guys, capital assets pricing model is a single period model relying on the correct determination of the beta factor, and with the market and risk-free figures used may be difficult to determine. Empirical evidence suggests that it overstates required returns on the high risk investments and understates required returns on low risk investments. This is the, you can say that the limitations or the drawbacks of the capital asset pricing model. The capital asset pricing model, it is applicable for single period. Now, there are also problems when we are using the beta of a proxy company. What is that? There may be a number of difference between the way H company operates and its cost structure compared with the Cosmore company will operate, given that H company is an established manufacturer rather than just starting up. Now see, we are using these values of a proxy company for ourselves. In the question, in the start of the question, it was stated that we are going to run this business for the first time. We are the new. We do not have any previous experience about that, but we are going to use the beta of a already experienced company who is already doing the same business since many years. So examiner is saying what is happening. There may be number of differences between the way H company operates and its cost structures compared with the way Cosmore operates, given that H company is an established manufacturer rather than just starting up. Difference in size between the two companies may also cause difference in their beta. H company's beta factor will have been based on historic data, may not be a reliable guide for Cosmore company future operations. This particularly applies if Cosmore company's investors built into their investments expectations about the significant growth of its ice cream manufacturing operations, which H company's investors do not have. So this is the very important point the examiner has explained. First of all, examiner asked, what is the use of the risk-adjusted discount factor? And then even we are using the proxy company, there may be some technicalities may arise. Miss, my voice is coming back to me, so please mute. Now, link between risk assessment and investment appraisal. The risk assessment process includes the quantification of some risk, the chances of them occurring, and their financial impact. Some of these risks may have been reflected as cost elements in investment appraisal. One problem with doing this is determining a threshold of likelihood. At what level of probability does a cost become likely enough to be included? And should allowance be made for the fact which is not 100% certain to occur or that is amount may be uncertain? For risk which are not deemed sufficiently like to be reflected as a cost, it may nevertheless be necessary to determine their impact on the results of the investment appraisal if they did materialize. So what the examiner is saying, examiner is talking about link between the risk assessment and then the investment appraisal. Examiner is saying the risk assessment process includes the quantification of some risk, the chances of them occurring, and their financial impact. If the risk have been categorized, have been reflected as a cost elements, one problem with doing this is determining the threshold of the likelihood at which level of probability does a cost become like enough to be included. And should allowance be made for the fact that it is not 100% certain to occur or that its amount may be uncertain. For risks which are not deemed sufficiently likely to be reflected as a cost, it may be nevertheless be necessary to determine their impact. Some risks which you seem that are important, their chances of occurrence are there, their likelihood is important, that may become the part of our investment appraisal, but that those are not necessary. There is no need to incorporate them. So first of all, there may be a problem when assessing the risk, that which risk is important and which risk is not. Then the second problem is the quantification of the risk. Given that some risk will be related to a new area of operations for Cosmore company, and it has limited historic evidence as a basis for your assessment, like this company is going to be a new manufacturer of the ice cream. So how you will quantify that which area is risky for that as compared to a business which is already doing this business from years ago? So some risk may also be very difficult to quantify, but may have a bigger impact than the risk which can be quantified. The impact of reputation risk, for example, not only depends upon the risk of events occurring that threaten reputation, it also depends on stakeholder reactions which are difficult to predict. However, if the new product gains a poor reputation early in its life cycle, it is very likely to mean that it is not viable. So this is the basically the theory which the examiner is explaining, that with part of the risk, first of all, you have to see the assess the risk, their likelihood, their chances of occurrence, and then their quantification methods. Some risks are difficult to quantify, some are easy to quantify. But if you are going to apply these methods onto the Cosmore company, so this methods of quantification would be very difficult because this is a new manufacturer. This company does not have any previous experience. We do not have any historical data available. Okay. Now the sensitivity analysis. For the revenue, the conclusion that lowering the selling price by 2% will lead in net present value to be of a limited value. The calculation looks at the impact of the selling price decrease in isolation and assume there is no impact upon the quantity sold. Now see, what is happening? We have said the sales. The sales is a product of sale price multiplied by number of units. So we are only talking about that if we will decrease the sale price by 2%. In this calculation, we have not said the number of units, because if the number of units will decrease, then the sales will also decrease. So examiner is talking about, we have talked only the isolation. The calculation looks at the impact of selling price decrease in isolation and assume there is no impact upon the quantities. It also assumes that 5% increase in selling price after year one can be maintained. We know that it was stated in the question. Whereas the initial selling price has to be lower, it may be more difficult to raise prices by 5% each year. So what is happening, guys? Examiner is saying that the 2% decrease will become your NPV 0. But first of all, we have only considered the one element, the sale price. We have not considered the quantities. And the second thing, in the first paragraph, it was stated that we want to maintain our price initially low and then we will later increase it. But how you will be able to increase it by 5% every year? That may seems impossible. So if you may not increase, automatically your sales will be decreasing. And if the sales will be decreasing, the NPV will become zero. So you should keep that in mind before you are going to put your funds in this project. Now, the calculation also takes no account for other factors which are significant in relation to the annual price rise. Competitor strategy may determine whether the price increase has to be varied each year. The level of inflation will also be an important factor. Not only will the level of inflation compared with the annual price rise influence whether the product is viewed as a better or worse value. It will also directly influence other variables in the NPV calculation, manufacturing cost, and the level of working capital. Very, very important point what the examiner is trying. Examiner is saying, we have said that the price will increase by 5% every year. You cannot increase it. First of all, you have to check the customer demand. Then maybe you have to check the reaction of your competitors as well. If you are overpricing to the, it will be maybe offending the customer that this is a new manufacturer, and maybe the customer is not currently addicted to the taste, and the customer may be not able to pay the higher price. So what will happen? If you will increase the price, your number of quantities will be lower, and again your sales will be lower. And then examiner is saying, the sales and the cost of sale, they both are directly linked to each other. If the sales will increase, your cost will also increase. Then if you are increasing the sales, your working capital requirements may also be increased. This you have to keep in mind. Now, initial investment. Although Cosmore company needs to ensure that the cost of initial investments are controlled. If they are, the figure for initial investment is likely to be more certain than revenue. Cosmore company should not only be concerned about ensuring the cost of the initial investment are not more than 7.5% higher than the forecast, as the sensitivity of the calculation of the investment depends on other factors as well. The impact of the investment will also depend upon whether the tax subsequently changes, affecting the tax and impacts of tax law adoption. The assumption that realizable value will be 10%, whatever figure is invested, may also be doubtful. That said, a nil realizable value will not by itself make an NPV negative. So what the examiner is saying, that the initial investment sensitivity is 7.5%. If you have to increase it by 7.5%, then the NPV will become zero. But in the initial investment, there are many calculations. Like we have computed the capital allowances figure as 4,000 per year. In the final year, there was a balancing allowance, and then the tax was 25%. So if these figures will change, our data will change. But the examiner is saying the impact of the investment will also depend upon whether the tax rate subsequently changes, affecting the tax impact of tax allowable deduction. The assumption that realizable value is 10%, on which basis we have said it is 10%, no clear picture has been provided. And then the linear programming. The linear programming model assumes that all the projects are divisible to any level. This is unlikely to be true in reality. First of all, what do you mean by the divisible? Like if I say I have two projects, one project is requiring, for example, 5,000, and the other project is also requiring 5,000. So the total investment required is the 10,000. But I have in my pocket only the 8,000. So if the projects are divisible, it's mean that, for example, in the first project, I have put the 5,000, and in the second project, instead of putting the 5,000, I have put the funds, whatever I have. I have divided that. This is known as divisible. But this is unlikely to be true in reality. For example, investments in non-current assets may not be easy to scale down. The linear programming model assumes that there's a linear relationship between the proportion of each project undertaken and the NPV generated. This may also be untrue in reality, as a minimum level of investment may be required to generate a positive NPV. This model assumes that investment in subsequent years cannot be changed. It ignores the possibility that the initial returns for one or more of the projects may be better than expected. This may mean that more funds are available than first considered, and also lead to reassessment of investment priorities. So this model is also based on the assumption that projects have to be undertaken now. It does not take account the possibility that some or all of the projects could be delayed and the impact upon NPV of delaying them. Also, the possibility of an option to delay. The examiner is talking about that whenever we are computing this linear programming model, we are saying that all the projects we have to take now, they cannot be postponed. But in reality, the real options are available. We can use of that as well, because the real options is a type of option where there is a option to delay you get as well. And then the conclusion will be there, and then report compiled by and signed.